We're going to start this morning, though, with the latest from Credit Suisse and its entanglement, both with Archegos and the ongoing drama at Greensill. That's also behind the write-down this morning and that charge. Yahoo Finance's Oscar Williams-Grut joins us now for the latest. And Oscar, Credit Suisse really being pretty aggressive when it comes to reacting to all of this, not only financially, but also in management. They're switching things up and letting some people go.
Well, Julie, they're being very aggressive today, but arguably they have to be because they have not been proactive enough up to this point, which has left them in this real mess. They warned today that the Archegos capital blow-up, which of course happened last week, will cost them an estimated $4.7 billion, which is more than they made in pre-tax profits for the entire of 2020. Shows you just how bad this one client is proving to be for them. As a result, and as you said, partly due to do with Greensill Capital, another client that went bust recently, they said they're expected to make a loss of just shy of $1 billion in the first half of 2021. They've cut their dividend, executive bonuses have been scrapped, and several key managers are leaving the business. Brian Chin, the head of the investment bank, is leaving, as is Lara Warner, the chief risk and compliance officer. They're also launching independent investigations into both Archegos and Greensill. Credit Suisse ran a $10 billion fund that invested in supply chain finance paper generated by Greensill, and the collapse of that business has left them with losses there as well. Chief Executive Thomas Gottstein said the performance across the board is unacceptable, said serious lessons will be learned, and pledged to essentially clean house and make good on some of the changes that have so far been lacking at the bank. Gottstein was brought in last year after Spygate, you'll recall, when Credit Suisse was caught up in all this scandal around spying on executives. So clearly, a lot of changes need to be made at the bank. As you said, shares are trading up today on this decisive management action, but they're still around 20% below where they were before the Archegos blow-up, well underperforming rivals such as UBS.
Well, I did want to ask about the shares a little bit further, Oscar, because it is a bit surprising. I mean, granted, the increase in European trading has been modest. Is it because they're down so much? Is it because, I mean, what are you seeing from analysts? Are people sort of encouraged that they're taking some management action here?
Well, I think the management action is key, and also just having a figure on how big this damage is going to be. You can then start to plan as to where we will go from here. But as I said, to look at it in the broader context, it's still down about 20%. People I'm speaking to today in the city say that while it is good that they are admitting their mistakes and taking decisive action, they still have to do a lot to earn back trust of investors. Last year, when Thomas Gottstein came in, his big pitch was essentially to pivot the bank towards more wealth management, its core area of focus, as well as Asia. Now, wealth management is, of course, all about looking after wealthy clients' money. Today's announcement confirms that really they've got a long way to go when it comes to stewardship, which is, of course, the key part of that piece. So I think it'll be a while yet before we see some of that ground made up that has been lost over the last week. But of course, today's move is a move in the right direction.